Majority of the times when people look at their house, they think that it's an asset, and I've been calling it a liability for a very long time because you can't take house from your head, right? Or from an investor's perspective, when you talk about wealth and wealth creation, as a retail investor, you will always look at property as an only path to wealth, whereas there's a bigger picture that is often missed. I think, from my perspective, I would always relate risk to return. And so when I say I'm not a massive risk taker, I would want that access to liquidity quite quickly. A lot of the times, a lot of retail investors go down the path of speaking to financial advisors, financial planners, and they take you down the route of, updating your insurances and taking it under their fund management. Hello and welcome to another episode of Help Me Buy Property podcast. Today's discussion is a bit of the left wing. We are going to talk not so much about property. We are going to basically talk property and wealth creation. We are going to, it's a cliche because, this is a property podcast, but I think wealth creation definitely goes beyond property. And for us to have that discussion, this is a two-part episode. We have Nilar Ispahany, founder of Zeteo Wealth Partners, a family wealth advisor dedicated to helping high net worth families achieving clarity and confidence in their financial future. It's amazing as to what you did or what you do, Nilar. I've talked to a lot of financial advisors, a lot of financial planners, and what you do with your clients is quite different to what a typical financial advisor and financial planner would do. Now, before getting into that, what I wanted to do was basically start off with your journey.
I was born in Burma. I was born in my grandfather's house.
Wow.
I lived under my grandfather's roof until I was at the age of 6. And then we migrated to Australia at the age of 7. We lived in Singapore for a little bit, and then Australia's been in Sydney ever since then. But my grandfather was an entrepreneur himself. So my dad's side of the family is very entrepreneurial. So they build substantial amount of business value and wealth in Asia. And then they've expanded into Australia and other parts of the world. In terms of my story, so I graduated from University of Sydney. I then went to work for Macquarie, was there for 4 years, then went into private wealth. So private wealth, what you refer to financial advice, is typically what we call in our industry retail wealth. So I've never been involved in retail wealth. I've always, sometimes a bit of fortune, a bit of luck, that I ended up in private wealth. I did stay in retail wealth maybe for about 4 weeks to a month.
Really? Didn't last that long.
Didn't last that long. And
How do you differentiate the retail wealth versus private wealth?
Retail wealth is a lot to do with an average person. So if you think about an average person, what do they need? They need budgeting. Budgeting is quite an important part of their wealth creation.
Sure.
And then they need debt. They use typically debt build wealth to sort of accelerate their wealth journey. And typically most of their wealth is concentrated in their home. And then maybe the second leg of wealth is super.
Sure.
That's sort of the typical journey. And of course, every retail somebody has to start somewhere. So all private wealth clients were retail at one point in their journey, and then they eventuate into private wealth.
And is there a fine line that translates from retail wealth? What defines transfer from retail to private?
Well, there is a hard way of looking at it, and there's a soft way of looking at it. So the hard way is the legislation, what the legislation defines, what private wealth or wholesale wealth and retail wealth is. It's basically defined on your net worth, so which is that 2.5 million.
Sure.
There's a lot of discussion whether that 2.5 million is sufficient anymore, given the increase in wealth in property that we've seen, because it includes property in that part of the pool. We don't. So if somebody comes to us with 2.5 net worth, which includes their house, we will say you're not because what we look at is we want to understand that you still need a roof over your head. So it has to be investable wealth as opposed to total.
And it's such an important part. I know that, we have digressed and, jumped right into the topic, but, majority of the times when people look at their house, they think that it's an asset. And I've been calling it a liability for a very long time because you can't take a house from your head. You would downsize and create or extract equity out of it. But ultimately, that's not the real wealth that, you can monetize and grow, right?
Correct. And even with, I've had a couple who had a $7 million house and they wanted to downsize. Moxin, if you think about their lifestyle, where they live, for that house to be worth $7 million and where they live, and if they were to downsize, it's very difficult.
Of course, you're not going to
So
live
you-
in an apartment, right?
Well, and even if they do live in an apartment,
Yeah.
they typically want, like a seaside view
Of course.
or some sort of. You're not going to live in an apartment where there isn't there isn't that luxury.
Hostel, right?
Correct.
Yeah.
So when people use downside as one of the strategy down the line, I always have a question mark around that, because there is an overestimation how much equity you actually release versus what the reality is. The reality is that you actually end up with very little. And also remembering that your lifestyle, if you lived in that part of the town, your lifestyle is very different. So your cost of living is very different.
And so, is it safe to assume that, it's only like the 1% of the investors who have access to people like you?
Typically, yes. Typically.
And so I think, for viewers and listeners, I think that this is an opportunity, right? Because I can imagine people asking gazillion questions. So talk to us, or from an investor's perspective, when you talk about wealth and wealth creation as a retail investor, you would always look at property as an only path to wealth. Whereas there's a bigger picture that is often missed. Let's talk about that. And, of course, segue that to your journey in entrepreneurship and, how did you grow in this space?
So just going back to my journey, so I've been in private wealth for almost 18 years now. I decided to start my own journey as opposed to being under somebody's umbrella just about 2 years ago. So the firm is under 2 years old. We have our own AFSL. The clients have been with me for a very long time. Although the firm is 2 years old, clients have been with me for a very long time. And in terms of how we look at wealth creation, we look at what is called a total portfolio approach or total return. So we have a top-down approach as to what are we actually targeting, and then we engineer backwards. So we start with some of the metrics. So what are we targeting? What's our risk budget? What does that mean to somebody? Okay, so there's a lot of terminology that I'm going to use, and so call me out and make me explain it. So risk budget. So what does risk budget? Risk budget is talking about what are the chances of me losing this entire capital, which is a downside risk. The second risk budget that we measure is the volatility, so the movement of the portfolio. So property is typically seen as a less volatile asset because it's not daily traded. It's what it is that you have in your mind that you put on your balance sheet. Sometimes it's slightly different to when you actually go down to sell it. It may not translate. We call that volatility. So that's the third metrics that we use, is called the liquidity budget. What does that mean is how easily can we sell this asset if we needed to. It's always so we're not looking to sell an asset in a positive environment. So we're always thinking about, if something were to go wrong, how easily can we get out of this asset? So that's what liquidity translates to us. So property we regard as a heavily illiquid asset, whether it's in the eastern suburb or western suburb, or doesn't matter where it is. When there is stress sale, it can take a while to sell. Similar to a private business, if I had shares in your business, Moxin, if I wanted to sell and your business is going down, or there is negative sentiment for me to sell my shares in your business, nobody will want to buy it. I will have to sell it at a heavy discount. So that's what we talk about, liquidity in a distressed environment. So we have a liquidity budget.
And so talk to me a bit about a client journey. Let's say a person comes to you and they have just recently translated from retail wealth to private wealth, and they have $2.5 to $3 million in hard cash plus their house. How does that journey eventuate? Like, how much of the allocation is property, and what do you do with their portfolio? Like, how does that typically work?
So if your client came to me with that scenario, the first thing is formulate what their net worth looks like. So it's a lot of question about their structuring. So where do their capital sits at the moment? How is it housed? And then the second part is, what are they actually looking to generate? Are they looking for income here? What are they looking for? Which is that return metrics. And is it realistic? So it was, I did have a client who came to me with a 20% return target. Is that realistic? Yes, we can, but we'll have to take substantial amount of liquidity risk is what we call. And are you happy to take that liquidity risk? So it's a bit of a understanding what the client is actually looking for. Often they know what they want at the back of their mind, but it's really difficult for them to translate that So it's the easiest way that people typically translate is a return. So they'll say, well, the highest return, right?
Yes.
Well,
Yeah.
why
And
wouldn't you?
100% return.
What does a highest return look like for you? Is it 10%? Is it 15%? And then sometimes if they don't understand that, then the way that I approach those subjects is, are we looking to double your capital in 5 years' time? Are we looking to double your capital in 10 years' time? What is that? So with property, I know a lot of people use the doubling your capital every 10 years, which effectively means that you're targeting a return of 8%. Right. So that's a total return. So that's excluding a net of all your expenses. A lot of people don't consider so a lot of people don't consider that there's always constant capital outlay that is required with property management, whether it's commercial property or real estate, residential property. So we factor all of that information in. So we look at the net return.
And do the clients get a preference as to, oh, I just want to do property with you guys, or I want to do X, Y, and Z, or
They
is
do.
it completely, return based as to what they are asking for?
No, they do. So firstly, we start with return. Even if you come to me with, I only want to do property, well, I say, let's just take a step back and understand actually what are you wanting from us. If I will always guide them to the return base, and then those risk metrics that are you comfortable with how much liquidity, and then if you already have a fairly large property portfolio, whether it's commercial, then the way that we will do it is, well, you already have that. If you're happy to maintain that, we don't have property allocation in our part of the portfolio. However, if you wish for us to look at it, because we're opportunistic, because we've got a total portfolio approach, so we go where the capital is calling us. If you say that doesn't matter what we have here, you do it as you see best fit, then we will bring the best ideas to you. But if you say, look, I already have this, I want you to diversify away from this, then we'll build it in that. So we can be very bespoke, but of course, if you're coming to us, you want our best ideas. So, with opportunistic properties, sometimes we're targeting a 25% IRR, again, which means 25% annualized return. So you're doubling.
The realistic return, Nilar, if I say to you that I'm not a massive risk taker, I'm handing over this $2 million to you, what is an average return that you would deliver on an annualized basis to a client?
You said it's something quite important. You say you're not a massive risk taker. What does that mean?
Oh, that's a very good question, because a lot of the times people cannot comprehend, or they cannot articulate what is that massive risk taker means. Look, I think from my perspective, I would always relate risk to return. And so when I say I'm not a massive risk taker, I would want that access to liquidity quite quickly. And so say maybe the money is there for more than 12 months, but less than 24 months, So that would be the headspace that.
And is that
cash it out.
the 100% of your
No,
capital?
I think you can do the allocation depending on that.
So if you say that I need access to 60% of my capital, but not 40% of my capital, we can manage that. But if you say I would like 20% of my capital to be liquidated, to be easily accessible within 30 days, again, we'll build that in that manner. In terms of what is an average return target? So typically most clients, and I know I get this a lot, it is depending on the client, but again, we can average it across the pool, because typically most people are quite similar in their risk appetite. So a private wealth client typically will be more growth oriented. Because they have the longevity. It's a generational wealth. It becomes a generational wealth because they're not building wealth just for them anymore. So when you're a retail, you're building wealth for you. You get to a point where you've got so much now that you can live, and now you're thinking about, how do I protect it? So it becomes about protection. So in that, the way that we build it is we always have about 20% of your capital is what we call protected capital. So I don't negotiate on that. So that's, if you're coming to me, you're telling, because if something goes wrong, you're going to blame me for it. So it doesn't matter what paperwork we complete or what contract we sign, you're going to point the finger at me. So even if you say, I want a lot of discretionary on how you handle capital, I will always have at least 20% a risk budget to protecting the capital. What does that mean? It means that these investments are not aligned to the economic environment. They're not aligned to policy. They're very different in the way they produce returns.
Sure.
I'm not even going to go into that because it's quite a complex area.
Yeah.
But in terms of the high level, we're talking about arbitrage investment. So we're buying an asset in one exchange and selling it in another exchange.
Sure.
We're doing futures contract. So again, through different markets, through different time
Basically,
frames.
it's all different types of,
Different types.
investments that you're talking about other than the property.
That's those investment goes into what we call the insurance basket.
Sure.
or alternative basket,
Sure.
which is there to protect the portfolio when things go bad. It's yes,
basically hedging, right?
It's a hedging.
You're hedging your property.
So we hedge the growth.
Yeah.
So equities.
In case something goes wrong.
Yeah, so properties are considered equities because you're buying an equity, so they come under equity.
Yeah.
So it's a growth asset. So property is considered a growth asset. There is some level of income, but it's typically in the portfolio as a growth engine. So we want to protect that growth part of the portfolio.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years, and there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
And so what is that magical number?
So we target about 12%, but we're getting at the moment our CAGR, which is the annualized return, is running at 19 with a volatility of just under 5.5%.
Oh, wow.
In comparison,
I'm assuming that 5 is good.
it's 1/3 of the market.
Yeah. Okay.
It's less than 1/3 of the market.
So 19% annual return. And how long?
That's the CAGR. That's the so we've been running for 2 years, as I said.
And so each year it's been basically rolling over at around basically 19%.
But yes, it doesn't mean that we target that.
Yeah.
That's what we're. So we overshoot and undershoot.
So for people like you, when you're talking about private wealth, has it been times where the money actually disappears? Like you actually go into a lot of losses and people actually end up losing a lot of money?
We haven't had in my 18 years. I haven't had any. I haven't seen. But yes, there is a degree where investment goes wrong is on the operation side of the business. It's typically not the strategy. So what do I mean by that? So if an investment comes to us, so there's an investment manager. There's a look, Nilar, we've got this great track record. I think it's phenomenal investment opportunity. Let's go. So the strategy might make sense and the strategy is really exciting. So we actually looked at one where we said no on the operation side. We love the investment and their track record has been 25% per annum for the last 4 years. But on the operations, we couldn't get our head around. So there was too much risk on the operations so that when things go bad, we may not get our money back. Yeah, because it was firstly, they run a very lean team. So it was 3 people, although they put it out as that it's a big shop. So our job is to track that capital. So that's the due diligence that we do. Yeah. So we do 2 types of due diligence. We do the due diligence on the operations, which is increasingly heavy load of work because we go into the details of who is making the decisions. Can we sit on your board? Can we sit in one of the meetings?
Yeah.
Can we talk to who's doing your auditing?
Yeah.
Who's your auditor? Who is your trustee? Who's your administrator?
Yeah.
And if we're not comfortable with any of that's where the investment goes wrong, is on the operation side. So if you hear about any investment that goes haywire, you don't get your money back. It's on the operation. Operations is weak. There's not a lot of Chinese walls.
Yeah.
So the person that's in control makes decisions and runs with the money.
Sure.
Right.
Yeah.
So it's not always, it's never really about the strategy. The strategy could be sound. It's, do we have protection?
So all of this, sounds amazing, but the world of private credit is super complex, right?
Yeah.
So for people who are still, playing in retail wealth, how would you explain in very simple layman terms, people who have known only property loans and mortgages, how do you explain this world to them?
Private credit is, it's not too dissimilar to loans and mortgages. It is with an increase and a few layers of complexity.
Yeah.
It's still a loan, so you're lending, and there's a lender, and there's a borrower.
Yeah.
But in terms of how it's structured is the complexity around it. So borrowing against real estate is fairly easy because you've got a collateral, and that's what the banks are wanting to do. So they don't want to do the complex loans anymore.
Yeah.
Which is why you've seen an increase in private credit, because private credit was typically done by the banks. It's a lending to businesses requires a level of complexity because the collateral is the business.
Yeah.
So where the complexity comes around is on the caveats used, on the structures of those deals, where where you sit on the capital structure.
Yes.
Real estate is, if something goes wrong, you take over the asset.
Mm.
Something goes wrong with the business, it's very difficult for you to take over the business.
Yeah.
So it's on the structuring side, and where you sit on the capital structure, whether you have warrants and options involved, whether you take ownership in the business.
Yeah.
So that's where the complexity comes in terms of private credit. So you really need to understand how valuations are done.
Mm.
Of course, everyone will say that we do our own valuation. You need to verify those valuers, where they're sitting, how they're valuing it. And then if I can offer any level of insight to people who are listening, is research the valuer extremely well. And then research the investment team, whether they've gone through a period of distress. If they've never gone through a period of distress, the biggest distress that we've seen is the GFC. Even 2020 wasn't really a distress. Well, because the governments came in, so we disregard 2020. So really, we want to see like a distress period like we've seen in GFC.
Yeah.
We want to see a distress period like we've seen in the Asian crisis.
See how they went.
Through.
Yeah.
If they've never experienced, we typically don't partner with them.
Yeah. And so, investors always worry about risk, right? If you really think about, in investment world, but can you share some examples in relation to the private credit space of how are you generating consistent income for people while protecting their capital?
Private credit, the loans are typically short-dated loans, so which is what we call duration. So we have a clarity on those, and typically these loans are now increasingly more fixed because we're on the downward trend in terms of interest rate.
Yeah.
Previously, if you asked me 12 months ago, it was variable. So we've got a fair confidence in terms of the reliability of income projection, and that's on an ongoing basis. So that's a reliability factor.
Yeah.
So we're fairly confident on the yield on those private credit. And in terms of clients, how they would allocate, again, if they're looking for income, private credit, it's not just private credit, we also look at public credit. So we're looking at the credit spread. Again, that's a bit of a jargon. A spread just means, what is the market paying in the public space? So if you're a company, if you think about a company, the way they can grow a business is two ways. They need money to grow because they need to spend. They can get money through three avenues. One is revenue growth, which is what Apple and Google, they've got lots of cash that they don't need any equity or they're self-sufficient.
Yeah.
But most businesses are not self-sufficient, so they need capital to grow.
Yeah.
So there are two ways of raising capital. One is to borrow, which is credit.
Yeah.
The other way is to release, to give some shares in the business as an equity. So you partner with us. Right. So same thing. So there's everything that exists in the private world exists in the public world. So public space, you've got public credit and you've got public equities. In the private space, you've got private credit and private equities. We float between the two depending on where the opportunity sets are.
Yeah.
Right now, the spread between the private credit space and the public credit space have thinned. So it's almost quite.
And what does that
Quite
really
this-
mean if it's
It means that you're getting almost the same amount of return
sure?
in the public space versus the private
And
space.
is it fair to say that public is a lot less riskier than private?
Public is a lot more liquid.
A lot more liquid, yes.
A lot more liquid.
Yeah.
So
Because there is the valuations would be
well, you can, because these bonds.
yeah.
So in the public world, they call them bonds.
Yeah.
Because you can trade these bonds
Right.
just like you can trade any shares. So they're more liquid, but it also means that their price is daily priced.
Yes.
So the price for you're the risk that you're taking is on the price fluctuations, whereas on the private credit side,
Yeah.
depending on who the manager is, and this is where the ASIC is looking into the pricing model, is that they don't really reprice this.
Yeah.
So
How different private credit is from non-bank lending or mortgage warehouses?
it's similar.
So
It's similar. Yeah, it's similar. So
and is it fair to assume that sometimes non-bank lending and mortgage warehouses have access to private credits where they are getting money from as well?
yes, but we don't do it because a lot of them sell their product as a liquid asset.
Yeah.
We're very concerned about the liquidity aspect of it.
Yeah.
Everything is nice when things are rosy. So we're increasingly cautious. I think, and don't quote me on this, I think there are about 600 private credit managers in Australia. Within there's going to be a huge amount of consolidation.
Yeah.
Because it's just ballooned out. So there's a huge amount of risk in the private credit space that we're watching. We typically staying away from that at the moment. So we're more in structured credit, which is the warehousing aspect.
And how do you help clients stay focused on the long game and consistently deliver results? I know that you say that you've been in the game for a very long time. You've been operating for 2 years. But how do you ensure that the clients consistently get the results that they're looking for?
We use a number of tools. So one of the tools that we use is called a wealth tracker. So at the end of the day, clients, if I always think about how I would like to manage my capital, I'm less concerned about the individual aspect of the portfolio because that's what you're paying us for. Where I'm concerned is, I put in $1 million today. What is that $1 million worth now? Next year, so how is my wealth tracking net of all outgoings, incomings and outgoings?
Sure.
So we use what is called a wealth tracker, and we typically focus on that. And clients so if we keep the client focused on that, then we remove a lot of the noise. But of course, it depends on the client profile. There are some people that want to go a lot deeper, and which we will go a lot deeper on, which is a line by line. When you go down line by line, they're more sophisticated. So what we call more sophisticated investors, because they understand the environment. And then we go a little bit deeper. And
what's one of the best stories that you can share with viewers and listeners today from a client perspective, achieving their long-term wealth?
And I think I shared this with you previously. It was a doctor in his 40s, build wealth through property. Typically, that was the easiest channel for them. And I think he came to me really frustrated because property management is quite onerous. And it was challenging for him. And he just sold one of the property. He had a very large property portfolio and still does. Sold one of the portfolio and said, Nilar, I want to retire in 10 years' time. So at the age of 55, when he's meant retire, he just means that he wants to have the option of not working long hours. He had 2 girls. So one started high school and one's about to start high school and wanted to spend more time with the children. I think he hasn't spent much time, so he worked really, really hard. So he received about $2 million out of the proceeds of one of the on the sale of the property. We wanted to convert that $2 million into $20 million.
Yeah.
And
in 10 years time.
In 10 years time. And I said, how did you get to 20 million? Why 20 million? And he said, I wanted a certain amount. He wanted $1 million income. If you think about $1 million income, 1 times 20, so that's the magic number. Yeah. Right. So that's how much capital you need if you didn't want to eat into your capital. And so you continue to grow your capital, but you benefit from the income to support your lifestyle. Yeah. So that's how you get to
20 million.
20 million.
Basically.
20 million or 5% is $1 million. And I said, okay, so to get to 20 million, I said to him, it's really impossible unless you want to take excessive amount of risk. So we went away and came up with a model. So gave him 2 proposals. One was use debt. So we were able to use debt because he was earning about $2 million in income. Gross. We used debt to produce that $2 million into a $3.5 million portfolio. Then we had a growth target of 15% on an annualized basis to get to 20 million. And and then we asked him, do you want us to service the debt or do you want to service the debt? Which means that we didn't have to derive income. So if you think about if we need income in the portfolio, which means that we're giving up growth.
Yes.
So it's a give and take.
It's the yield that you
Yes. So it's a balancing act. So for him, he wanted to service the debt, which he did. If he was to service the debt, he was just out by 2 years.
I think it's a very powerful story. Any final words for people? Because I know viewers and listeners, they wouldn't have access to people like you because majority of these people are playing in the retail space still. What would you say to them as like a final golden words?
I think if you contemplate, obviously if you're listening to this and if you're contemplating, you've done really well. So congratulations, firstly. Secondly, is just to think about a bigger picture. Diversification is important. I know it gets used a lot, but diversification can also be a detractor. So using diversification really well and concentration really well is really important for, particularly in that part of the world, because you have the ability to go deep. But you want to protect that capital. So protection is equally important as growth. So don't give up. Don't underestimate protection. So always protect the growth engine. So don't think that property is quite safe. It is safe relatively. It's because Australia hasn't gone through a significant downturn in property. But if you speak to South Africans, for example, if you speak to people from Portugal, if you speak to Americans,
they've seen the property.
They've seen it. I think the only market that is extremely bullish on property is New Zealanders and Australians. Outside of that,
the property going down, right?
Yeah. Correct. Now the Chinese market has gone down by 40%, so they've become a little bit more bearish. So until you go through a significant period of downturn, you will never see. And I think Australia has been really beneficial in that way.
Maybe we are very privileged and blessed, in that.
I fundamentally don't know that will last very long. It's impossible.
Where can people find you, Nilar?
I'm not very active, but you can find me on our website, but on LinkedIn, but always available. So my phone number is there. So it's much easier to reach out. I don't do a lot of socials.
Yeah, it's the first time, so thank you.
So you can find me on our website. I think it's the best way.
And look, viewers and listeners, I think this is one of the most exciting podcasts from my perspective, because a lot of the times, a lot of retail investors go down the path of speaking to financial advisors, financial planners, and they take you down the route of updating your insurances and taking it under their fund management and generate basic mediocre returns of 4 to 5 to 6%, which you don't need a lot of mindset and mentality to deliver some of these returns yourself. So if you have any questions for Nilar, always you can reach out to us at info@helpmebuy.com.au. Thank you for listening to us today. Do come back for the second episode, because we are going to talk about generational wealth and how do you pass on that bet. And thank you for listening to us today. Take care, stay safe, keep smiling, keep investing. This is Moss and Nilar checking out. Adios.